Well, good evening, everyone. It's exactly 6:30 here in the UK. Welcome to our VectorVest webcast, where I'm going to try and detail the most conservative trading plan in the VectorVest arsenal. Those of you that think of yourselves as aggressive traders, don't be disappointed or downhearted, because the methodology has produced exceptionally good results with very, very little effort over the last few years. So just to start off, folks, could I do a sound check? I haven't had anybody, in fact, just let me know that you can hear me okay. Maybe Emilio, right at the top of my list, if you could let me know that you can hear me okay. I think it should be okay. Hello, Philip. Hello, Philip. Thank you. That's very kind. Okay, so Dr. Philip Chan has just, in fact, confirmed that you can hear me okay, so we can move on. And also, a big good evening to those people who are listening on YouTube. I'm streaming this on YouTube, and those first souls on YouTube can actually see me live, whereas on Go to Webcast you can't. Maybe I don't know whether that's good or bad. Folks, the first thing that I have to do is that I've got to put up the VectorVest disclaimer. VectorVest is pretty much the only organization that's in fact authorized by the regulator, the FCA. And although I'm qualified to give financial advice, I can't do so because I haven't sat down with you and done a long and detailed fact find. I'm allowed to talk about shares that I hold myself, but I have to make it very clear that although the shares are suitable for me, they may not be suitable for you. So that said, we can move on, and that's my objective, folks. My objective is to show you how to, in fact, invest with confidence and outperform the market in a few minutes a day. First of all, let me just make it clear, I'm not talking about day trading here, because I've confused people in the past. I'm not talking about buying the market at 9 o'clock and selling it at 10 past 9. Nothing could be further from the truth. What I'm suggesting is that we use VectorVest to put together a portfolio of shares, and we spend 10 minutes a day, every day, managing the portfolio. That's all. Most days, there'll be nothing to do. And largely, there hasn't been much to do since last November. And I'll show you how well the portfolio is done in that period of time. So that's my objective. And the goal is to show you how to retire younger with more money than you ever thought you could, with 3 ways. Well, the first way is capital growth. That may seem obvious, but we want to buy shares where the companies are going to make lots of money, and that will be, without a doubt, reflected in their share price. Secondly, we want to collect dividends and put those dividends back into the mix. That makes a huge difference over a few years. And the third way, although it's virtually impossible in the UK, is that to write covered calls on the shares that you've got. Now, if you are in the US, listening from the US, this is very easy to do. And the options market, especially writing options, is very liquid at the retail level in the US. Writing covered calls and shares that you've got is pretty much the most conservative option strategy there is. And my colleagues in the US who do that say that you can easily add in another 5 to 10% a year into the mix by doing that. Now, in the UK, we have only got 1 and 2, really. We want to buy shares that are going to make lots of money, that those earnings, those profits will be discounted into the share price, that pay a dividend and have got a history of growing that dividend. And by adding that dividend into the mix, you can make a huge difference over a few years. Just do some compounding sums on Excel. So that's what we're going to try and achieve. That's me. Unfortunately, just a day or two away from 66, that photograph taken a couple of years ago. Those of you that are on YouTube will be able to see whether I'm standing up or not to the wear and tear of 2 or 3 lockdowns in a row. But that photograph taken while I was at the New York Stock Exchange some years back, well, 2 years back. So what we're going to cover today, and I don't want to keep you too long, is the VectorVest system of analyzing shares. And during the presentation, folks, I use the word shares and stocks interchangeably. So in some sentences I'll use stocks, some sentences I'll use shares. To me, they mean the same thing. We're then going to talk about something which is quite controversial, and that's market timing. And we firmly believe that there's a good time to be in the stock market and an awful time to be in the stock market. That's a little controversial, I know. And then what I want to try and do is to put it all together into a simple plan that you can action in a few minutes a day without a great deal of effort. So let's make a start. The 3 magic words in the stock market: earnings, inflation, and interest rates. Now, if you've been reading the papers, listening to the news, you will have noted that inflation is in the news. And inflation going up is not good for stocks. If there is inflation around, invariably interest rates go up to tackle that inflation. And that's where the American market and all major markets in the world are at the moment. Inflation seems to be coming, but nobody's willing to put up interest rates. And the word from the Fed and the Bank of England is that inflation is transitory. In other words, it's a temporary thing. We shall see. We shall see. There are quite a few people around the world, heavyweights, Paul Tudor Jones, for example, who says that inflation is more ingrained. Nevertheless, the 3 things that affect stock valuations and stock prices: profits, inflation, and interest rates in the general economy. And out of that, Dr. Bartolito has put together an algorithm that calculates the value for every share on the London stock market every single day. So we can see at a glance, what's the stock really worth? We can see at a glance, how safe is the earning stream? And we can see at a glance as to whether it's on a buy, sell, or hold recommendation. So I need to go into a little bit more detail. A very important measure of value is called relative value. And relative value is an indication of the long-term share price appreciation potential. And for long-term, that means 3 years. In relation to what a corporate bond will pay in the same period. Now, how do we do this? Well, we forecast the profits of every company on the LSE for the next 3 years. So we work out what the share is going to make next year, the year after that, the year after that. And we do that by extrapolating from the financial statements, and we do that by buying an earnings forecast from the world's top provider of such a company called FactSet. So, and we've got 30 years experience in doing this, so it's not new. We work out the profits that this company is going to make over the next 3 years. We assume that those profits, those earnings, will be discounted into the price at some time within that 3 years. And we work out what that projected price will be. We take the projected price and subtract the price today to get the upside, and we divide that upside by what a corporate bond will pay in the same period, the same 3 years. So this is an accurate projection of how much the share price will increase in relation to what a corporate bond will pay. Less than 1 is not good, because this means that there's a high probability that your company is going to underperform a corporate bond. Now, those of you that are familiar with the pecking order of who gets paid will know that the bondholders get paid an awful lot before the common shareholders. So it would be silly, in my opinion, to invest in a company with a relative value of less than 1, because you could get more money by investing in a corporate bond with much, much, much less risk. Greater than 1 is not bad. And to satisfy the capital growth requirements so that we can get wealthy in a reasonable amount of time, we've proven that we need a relative value of greater than 1.25, and many of our users have proved that for us. So the first requirement, ladies and gentlemen, for our worry-free trading technique is that we want a relative value of greater than 1.25. A big part of relative value is earnings growth. Relative value is one of the most useful measures of value that I've ever come across, because it answers the question that's always perplexed me and many, many other people. The main measure of value that's touted everywhere is the price to earnings ratio. And that's the price of the share in relation to how much profit it made last year. So if you've got a share on a price to earnings ratio of 20, it's largely saying that it's going to take 20 years of earnings to pay back that company. Now, on face value, it may be obvious that buying into a share on a PE, let's say of 5, is much better than buying into a share on a PE of 80. But as one of my mentors, a gentleman by the name of William Gann, used to say, if it's that obvious, it's obviously wrong. And on many occasions, the share that's on a PE of 80 is actually a much better buy, because earnings are accelerating. So on a PE of 80, it's got a huge relative value. Whereas a share on a PE of 5, where the earnings are falling off a cliff, may have a relative value going forward of 0.7. And this was brought home to me very clearly by a good friend of mine. He was the head of asset management for a London and Johannesburg listed bank. And he started his own shop, and he did very, very well for a long time. And then he, like we all do from time to time, he fell in love with one company. The company was trading on a PE of 5, and that's why I've used the number. And he felt it was the best buy in the world. And he kept buying more and more and more of it. There was a good reason it was on a PE of 5. It was going broke. And the company went broke, and he lost his company. Not because of that one decision, but because, my word, if you're managing money for somebody and one of your shares goes bankrupt on you, you'll find that the clients will run for the door. So relative value answers that age-old question: is it better to buy a company on a PE of 5 or a PE of 150? So in terms of measuring the value of a company, relative value is much, much more use than PE. I'm not saying that PE hasn't got a place, but relative value, a very, very important measure. And I could go on for hours on relative value. Now, the next proprietary VectorVest metric is relative safety. In relative value, we're projecting the future. And as Mark Twain said, the future is a very risky commodity. Relative safety, we're looking at the past. And we're looking at the consistency and the predictability of the financial performance. So what Dr. Lido's algorithm does is that it looks at the balance sheet, the income statement, the cash flow statement. It looks at dividends, dividend safety, dividend growth. It looks at margins, or margins in the company expanding or contracting. And it sucks them all in and prints out one number on a scale between 0 and 2, which measures risk. Less than 1, as you may have guessed, is not good. Greater than 1 is fair. And greater than 1.3 odd, this is really good. This is a company that's making money and all the financial ratios are getting better. Now, what I'm talking about this evening is a worry-free, hands-off trading plan. And in that hands-off trading plan, ladies and gentlemen, we are going to, in fact, emphasize safety and predictability of earnings. We don't want surprises. We want the ball to do the work. But we still want to make some money. And to get that mix is not easy. And that's why for a worry-free trading plan, I've stipulated that the shares should have a high relative safety plus a high relative value. So, and these are very special stocks. These are stocks that have got a high probability of growing earnings strongly and have a safe track record of doing so. And there's not that many of them on the UK market. They are what I call sweet spot stocks. That's what we're looking for. We're looking for the very best stocks in the UK that have got the ability to speed forward safely. And I have to apologize for the rugby metaphors. I played rugby for a long time in my life. The third measure, preparatory measure, is relative timing, which measures the short-term price trend of the share. Now, if I was doing a seminar on momentum trading, this is very, very important, but I'm not. As a default, all of the shares on VectorVest are sorted by VST, value, safety, and trend. And Dr. DeLito has put these three VectorVest metrics into the one single indicator, VST. Again, for momentum traders, that's great, but we're not momentum traders tonight. We're worry-free, hands-off traders. And what I'm going to do is that I'm going to change the sort, and I'm going to, in fact, sort all of the shares in the London market by safety and predictability of earnings. We do not want surprises. Again, ladies and gentlemen, if you class yourself as an aggressive trader, don't worry. The performance of this has been incredibly good. We're looking for companies, very special companies, that have got the ability to grow earnings strongly and a proven track record of doing it safely. A really, really great place to be. We calculate a stop loss for every share in the market every single day. And that stop loss is loosely based around a 65-day moving average of the share price, adjusted for the fundamentals. And if the fundamentals are good, and they're going to be good for worry-free stocks, we widen the stop loss. So we give the shares with, in fact, good fundamentals more room to move. And finally, in terms of definitions, we put a buy, sell, or hold to every share in the market every single day. And this can certainly be used for entry and exits. And the buy, sell, and hold are largely trend-following tools. The only fundamental input for a buy is that the VST, value, safety, and trend, must be greater than 1. Clearly, for a sell, the price is below the stop loss, and then for a hold, the price is above the stop, but one of these three are not maintained. For our worry-free stocks, folks, I want the share to either be on a buy or slugging sideways. If it's below its stop loss, I'm not interested in it. So in brief, for our worry-free system, I want shares with a relative value of greater than 1.25. I want shares with a relative safety that are greater than 1.3. And they should be on a buy or a hold. And later on, I'm going to have written a little Unisearch that finds these automatically. But as demonstrated yesterday afternoon at our weekly session, the lady who runs our London group, Susan Thornborough, she does it by eye, and she explained that technique yesterday afternoon of how she finds stocks, very similar stocks to this, very quickly and easily without any effort whatsoever. And my word, does she trade well. So let me just look at the program itself. If I get out of that and I go to VectorVest UK and I go to the home page, I'm going to get to this home page in a second, folks. But if I click on viewers, and I've been working on this most of the day, if I just clear that, that will take us to the stock viewer. And as you can see, we're following 2,069 companies on the London market. And the default sort is value, safety, and trend. Now, one share that I've been looking at, been talking about to anybody who listened to me, is Future. Future has had an outstanding run. It's run a little bit past its valuation. So for the moment, the share is looking pretty much fully valued. It was down 4 pence yesterday. But folks, the relative value is a whopping 1.56. And that's telling me that there's one heck of a lot to come over the next 3 years, that it's going to outperform a AAA listed corporate bond by 56%. Now, all we want is 1.25, so 1.56 is an outstanding number. The relative safety is 1.29, which I would certainly let in. And the relative timing is 1.79. Now, there's lots and lots of other metrics here that I haven't got time this evening to explain, but I'll explain them all at a future date. That's the stop loss. The CI measures the long-term trend. So the RT measures the short-term trend. CI measures the long-term trend. Long-term trend looking good. And this GRT is the percentage annualized growth of the company in terms of earnings next year. At 37%, that's quite something. And GRT is a big part of relative value. So outstanding numbers, a little bit over, it's going a little bit too far in the short term, but over a window of 3 years into the future, my word, there's an awful lot of upside in this company, and the safety of earnings is good. Let's put up the chart. And that's the chart, folks. You can see the buy, the last buy, if I can get my vertical line, the last buy was, wrong line, freehand line. The last buy, I think, was, no idea why that doesn't want to work. Yeah, there we go. The last buy was somewhere about here. That's under 20, and we've now moved up to 31. That's from April. This breakaway gap in a share like this. Let's look at earnings per share. There's the earnings per share, folks, rising very strongly indeed. And on VectorVest, this earnings per share rising strongly. As you can see, over the last year, earnings has risen from 60 pence to £1. That's quite something. This breakout of this ascending triangle looks to me as if it wants to go much higher. Good money made there. The Character Group is a small company. There's no doubt it makes calling cards and things, but it's had a good run. It's trading at 6.97. VectorVest believes it's worth 10. That's good. The relative value is 1.53, which is outstanding. The relative safety, 1.32, which is good to excellent. RT means it's rising strongly. The CI means it's rising. The long-term trend is good, and it's going to go earnings at 22% next year. So that's quite something as well. 37 is amazing growth rate. So we have a look at that one, and there's no doubt that it is a tad illiquid. But it looks to me as if it wants to go much higher. If I put on the valuation, there's the VectorVest valuation right up here. And those are the sort of shares that you can find very easily indeed. Susan Thornborough just goes through it manually and she finds them from the stock viewer. But later on, we'll automate that process so that Unisearch, in fact, will do that for you automatically. So we're looking for some very special stocks. We're looking for stocks that have got a proven ability to grow earnings safely. And because we're hands off and we want the ball to do the work, relative safety is absolutely vital. Relative safety does not mean that the company won't drop the ball. It means that there's a very low probability of it dropping the ball. We had one company drop the ball in the last year, and that was Avon Rubber. So they do happen, but they don't happen often. Okay, there's a probability associated to everything in the stock market. There is no sure thing. Relative safety, a high relative safety minimizes that. So back to my PowerPoint presentation, folks. We want to buy and be in the market when the general market is rising. And we believe in buying rising stocks and rising markets. And if it was another presentation selling falling stocks and falling markets, short selling. And Dr. DeLito says being on the wrong side of the market is the worst thing that can happen to an investor. It doesn't have to happen to you. Now, I started investing, folks. I put on my first trade in October 1982. And I had some good years and bad years up till about 87, 88. And it took me a while and some books to realize that on many years, I was battling against a market that was falling. And if you ever get a chance, there's a wonderful book called Reminisces of a Stock Operator, where the hero is a fellow called Larry Livingstone, but it's modeled on Jesse Livermore. And Livermore went through a similar learning curve where he found after a couple of years that you just can't battle against a market that's falling against you. So it took me a long time to work that out, and a lot of frustration to work that out. But everywhere we look, people say ignore market direction. It's time in the market, not timing the market. And maybe if you've got £1 billion under management, that is true. But for most relatively small accounts of up to £2 or £3 million, you can get in and out of FTSE 350 stocks by pressing the button. And when I'm up to a couple of billion, I'll worry about it then. But at the moment, as long as I do my homework and invest in shares that have reasonable liquidity in relation to my portfolio size, I don't have a problem getting in and out. And you may have worked out yourself over the years that they rise very quickly and they rise very slowly and they fall very darn quickly. And that's my simple metaphor for a stock market. It takes forever to get up there and they fall very quickly. Those of you in the markets last February would have noted that. Now, the front page of VectorVest is all about the general market. And I'm going to go out of PowerPoint now, and I'm going to go into my VectorVest itself, because if nothing else, it's just a little bit bigger. And that's the front page of VectorVest. It's an end of day program. Everything that you need to know can be arranged in these little boxes, so that you can see what's important to you at a glance. And VectorVest comes with two very cool little apps, one for the Apple phone, one for the Android phone. And a quick look at that, and you can see how your shares are doing. And a quick look at that, you can actually work out whether the market is rising or falling, and everything follows from that. Now, a quick gander in the front under trend here. The two most important words on VectorVest are up and up. As you can see, a few days ago, they were down and up. And what we've done is that we have digitized the trend of the London stock market, so that those people who don't like charts don't have to plow through charts. Up, up. The first word refers to the short-term trend of the London market. The second word refers to the underlying or the longer-term trend. And sometimes I get a question, how can there be two measures of the one thing? Well, think of it like this. Think of it like two boats, a little boat and a big boat. And I think you would agree that the little boat can hop back and forward, whereas an aircraft carrier can't do that easily. And similarly, a short-term measure of the trend can reflect short-term noise in the market, whereas the underlying trend smooths that out. A short-term measure of the trend and a longer-term measure of the trend. And tonight, the short-term measure of the trend is up, and the underlying measure of the trend is up. So both little boats are going in the one direction. Here, folks, for a couple of days at least, the short-term trend was down, but the underlying trend was up. Now, for a buy, we want them to be pushing in the same direction. Next to the trend is a column called call. And the call is the longest term measure of the trend on VectorVest, and it's called a C-up, or a confirmed call. And the confirmed call is no more than the second word, the underlying trend, confirmed by 2 weeks price action. What is this colorful thing in the middle of the page? Well, the traffic light measures the strength and the momentum and the breadth, the number of companies participating in it, of the short-term trend. And although today the short-term trend is up, it's not up with a great deal of conviction. And the old traffic light, the pointer's in the amber. And VectorVest advises caution when buying stocks at this time. Now, we debated an entry point for a worry-free trading plan some years back. And one of our subscribers from Wales, Carwin, I don't know if you're in the room or not, but Carwin suggested that for a buy-in, we want a confirmed up in place, and that the pointer should be firmly in the green. That means that the short-term trend is up with conviction, and the underlying trend is up and confirmed by 2 weeks price action. So for a buy signal, those are the conditions. A confirmed up. Now this confirmed up has been in place since the 11th of November last year. So the confirmed up smooths out, like the aircraft carrier, it smooths out a great deal of noise and just keeps going forward, ignoring the noise. Absolutely perfect for our worry-free trading plan, where we don't want to react to that noise. Short-term traders and spread bettors, we've got other methods of measuring those short-term trends, but for our longer-term worry-free plan, we simply want to be in sync with the long-term trend of the London stock market. Now, what's this based on? Well, if I click on timing, and I can pull up a chart. Now, some people love charts, some people hate charts. And this is the London stock market as measured by the VectorVest composite. This is a composite indicator of all of the shares that we follow in the London market, 2,000 odd shares. It's the broadest measure of the London market that I personally know of. There may be broader, but I don't know of it. Now, down below here, we've got all of the VectorVest market timing systems. Confirmed calls are the longest. That's what we're going to use for worry-free. The short-term trend is the shortest, very noisy. Now, a medium-term market timing system that I find very useful for spread betting and short-term swing medium-term swing trading is the DEW. I'll spare you the acronym. And then these are also short-term trading systems where we've looked at both price and momentum. The RT kicker is just a rate of change of the momentum. So if I click on confirm calls, it automatically populates this with green and red triangles. And the last confirmed up occurred on the 11th. Now, clearly along the way, there's been lots of ups and downs. For example, I mentioned a few days ago that the short-term trend was down, and that was that little bit of a pullback. In that pullback, the short-term trend turned to down, but the underlying trend was still up. Similarly, short-term trend was down here. The short-term trend was down here. We want to buy stocks, ladies and gentlemen, when both boats are heading in the one direction and the little boat is moving forward with conviction as measured by the traffic light. That's the sell-off. Last year. There was a similar sell-off in November, came to nothing. Maybe the old vaccine came to our aid. I think that's when Pfizer announced the vaccine, but that's what the market did. So sooner or later, ladies and gentlemen, we're going to get another one of these. I don't know, and although the chaps on the television look very knowledgeable, they don't know either, because many of them call me to try and get my view. They don't know whether it's a small little pullback like this or all hell's going to break loose like this. So when you get a confirmed down, you need to cancel a fishing trip. I'm joking. It takes a few minutes a day to keep this under control. You can do it from anywhere. But all I'm saying to you is you need to be more diligent. High relative strength stocks, high RV, high RS stocks tend to go quite sweetly with the market. When you get a confirmed down, and it's just a small pullback like this, the high RS stocks are very resilient. But ladies and gentlemen, if you get something like this, everything falls. All right, everything falls. And then the next one, you don't know whether it's one of these or one of these. That's the reality of the situation. So when we get a confirmed down, we want to be very careful. We want to watch our stop losses much more carefully. We certainly don't want to sort of say, should we, shouldn't we, give it another day. Sometimes that's beneficial when the market is rising to give it another day. That's certainly helped us in our Monday afternoon things. But when you've got a confirmed down, then you've got to be resolute on your stop losses to hold on to those profits. Now, here's the plan. When we have a confirmed up, as it moves up here, invariably the traffic light is saying yes as well. But when we get a confirmed up, we want to be fully invested in 10 to 15 high RV, high RS stocks. Sooner or later, there will be a confirmed down. I don't know when it's going to occur, but sooner or later, there will be one. Markets are like us. They breathe in and they breathe out. When we get one of these red triangles, which are going to be automatically put on your chart, and on the front page of VectorVest, where the confirmed up was, that will change to confirmed down. So you don't need to look at any charts at all. It'll be on the front page of VectorVest that's on your phone, and there's no excuse, because let's face it, we spend half our lives looking into bloody phones. So there's no excuse for not knowing whether the market is rising or falling. But sooner or later, there's going to be a confirmed down. When you get a confirmed down, ladies and gentlemen, do nothing, but resolve to be much more diligent and strong and disciplined on your stop losses. If you get stopped out during a confirmed down, in other words, the share that you're holding closes below the VectorVest stop loss, simply sell it and build a cash position. So if we got a confirmed down in the weeks ahead, and I got stopped out of 3 shares, I would be 70% in shares, 30% in cash. When we get the next confirmed up, which I assure you will arrive as sure as day follows night, I want to get back to fully invested again. So when there's a confirmed up, I want to be fully invested. When there's a confirmed down, do nothing. But you're more likely to get stopped out of even a high RS stock. Simply sell them if they close below the VectorVest stop loss, and VectorVest will send you an alert via an email to tell you, and build a cash position. Now, on this little pullback, on the worry-free portfolio, we were not stopped out of anything. On this one, I was stopped out of everything. Everything. Okay, that's the first time that that's happened. We've been stopped out of everything since 2008. So that's the process. It's a simple process. It's mechanical. And it requires very, very little monitoring, save when you get a confirmed down. When you get a confirmed down, you've got to be on your toes, and you've got to do some deep breathing to be resolute on your stop losses. If you're slack on your stop losses when there's a confirmed up, well, there's a good chance you'll get away with it. If you're slack on your stop losses on a confirmed down, well, you could get one of these. And if you get caught in one of these, then you got to sit in all of this to try and get your money back if you're lucky. Okay, so that's the process. So the next little bit, how to build and manage a worry-free portfolio. Well, if you come to our Q&A sessions, which we have every Monday afternoon, and we have a national user group once a month as well, Susan Thornborough will show you how she does it just by looking at the stock viewer. But Unisearch will in fact do it for you automatically. And Unisearch, the search that I've written for worry-free is very simple, but you can do some wonderful things with Unisearch. You can in fact put together fundamental measures with technical measures. So if you like the MACD, you can in fact find MACD signals and shares with outstanding growth fundamentals, do all sorts of wonderful things. Now, at our next national user group, which is Wednesday, I think the 21st of July, we have a guy called Mark Crittenden who knows more about Unisearch than anybody else in the VectorVest world. And he'll be talking to us about Unisearch, how to put together Unisearches that have worked for him. My word, he knows his Unisearch. So what we're going to do here is quite simple and robust. And ladies and gentlemen, for our worry-free plan, we want to find the UK's very best stocks. Those stocks with that combination of safety and predictability of earnings and strong earnings at the same time. There's not that many of them. I've tested this over the years. And I'm 66, apart from a couple of weeks. I'm fed up back testing. I test everything going forward. I haven't got enough time to do any more back testing. I test everything going forward, and I've been testing this with my own money now for the last 3 or 4 years. And I'm 100% sure that it works if you stick to some very, very simple rules. There's very little to do in worry-free investing. And it is my experience that if you cannot muster the discipline to follow the rules of this methodology, which are far and few between, then you don't stand much of a chance in following the rules of a discretionary portfolio where the market, especially short-term portfolio, where markets are moving very fast. So this is a great place to start. And it could be the last plan you ever need. Now the key is relative safety. We want that relative safety to hold up above 1.25, and at the moment there's so many of them that above 1.3, but certainly above 1.25. As you saw a second ago, I was okay with future at 1.29. Now we want earnings to be strong. Remember, we want that mix between safety and earnings growth. And GRT, percentage annualized growth rate, is a big part of relative value, and relative value greater than 1.25. Okay, and that's a very simple little search. It's on your VectorVest as a standard. It's under long-term winners, RS descending, and that's the search. The stock must be above 50 pence. I put a very small traded volume, 50,000 shares, as measured by a 50-day moving average of volume. I've excluded AIM. Now, one of our best researchers from our Guildford group, Mark, has taken that out and makes the case that there's some exceptionally good stocks on the AIM market, and I've no doubt he's correct. But for this search, I've in fact excluded AIM, and the little double arrow means not. The relative values, as I've explained, should be greater than or equal to 1.25, and the stock's buy, sell, or hold recommendation should not be on a sell, thus it must be on a buy or a hold. And we're going to use the confirm calls. I didn't get time to, in fact, tell you the mechanics of how the confirm calls are in fact generated. Again, if you come to our Q&A sessions, I in fact wrote an essay about that today. So if you're a member of VectorVest or you want to take a trial to VectorVest, you'll get an essay on that on Saturday morning. And remember, as Carwin suggested, we want to get in with a confirmed call, and that old traffic light is pointing well into the green. In other words, the short-term trend and the long-term trend are in sync, and the short-term trend is speeding up. So our positions get into profit quickly. That's the VectorVest composite. Now, since last April, that's the April signal there, and that was a difficult time. I actually got into some speculative positions well before that. From March the 24th, I got in. And for those of you that are VectorVest customers, I got in based on the DEW signal down there. When it's time to buy, you won't want to. Just remember that. And similarly, when it's time to sell, you won't want to. My very first desk head here in London drummed that into us about 25 years ago. When it's time to buy, you won't want to. And I've told the VectorVest regulars many times that when I bought shares down around here, starting from the 24th of March last year, I got emails with language in them that would make a Royal Marine Sergeant blush. So they told me I was a complete idiot, and they prefixed the idiot with something fairly colourful. But we managed to get in down around here, and largely, apart from one stock, we're holding those shares the whole way up. And I'll show you the test now. Now this is a simple linear test, and the stock we got out of was Avon Rubber. So that one, although it's just down 2%, it pulled back and hit its VectorVest stop loss. But that portfolio is up 53% in that period. The market's up 35%. So it's outperformed the market significantly. Now, I know an awful lot of day traders that have been sitting in front of the screen all day, every day, with square eyes, who haven't made 53% last year. In fact, IG will tell you immediately that 70 to 75% of them have lost money. Let the ball do the work. Stay out of the noise. Put a big trend at your back in shares with an outstanding mixture of growth and safety. That's the basis of the technique. Since last November, the market's up 14%. This portfolio is up 20%, which is a 33% annualized return since last November. That's about 7 months. So that's quite respectable. In 2019, that's what it did. Great year, 2019. And going into the COVID disaster, I was up 50% nearly. And I gave back 16%. So from the start of 2000, the first signal in 2019 was the 9th of January. There'd been a sell-off October, November, December 2018. That's when the Fed said they were going to put up rates. Never happened. That was the biggest turnaround in Fed policy that I can remember, and I've been watching them for 40 years. The first signal was the 9th of January 2019, and largely we sat in this one portfolio the whole year. There were 2 trades in the whole of 2019, that's all. I went into the COVID disaster with up 48%, give 16% back there. So from the start of 2019 to halfway through February in 2020, up 32%. And the portfolio from the lows is up 55%. That's what the technique is doing. It's simple. I think intuitively it makes sense. The UK's best shares with that mixture of growth and safety when the general market is rising. And at VectorVest we have got quantitative measures to measure the fundamentals of the share and to measure the technical position of the overall market. That's the equity curve in 2019. That's when we had those 2 trades. There was 2, got stopped out twice there on that, a bit of a sell-off, and it came to nothing, but we got stopped out of 2 shares. So at the end of that sell-off, there was 80% shares, 20% cash. When we got the next confirmed up, back to fully invested again. And I tested this over 20 years, folks, in the US. Started off with $100,000. Along the way, we got $51,000 worth of dividends. And by the way, those previous results, I didn't count in dividends because the program doesn't give us the flexibility to add in dividends. So most of those shares that I spoke about, I would have paid a 3 to 5% dividend yield, and maybe twice during that period since last April. So we took 51,000 in this test over 21 years and just assume that that's been blown. It didn't go back in. And that's what it's done. Clearly, That's 2000 to 2003. That's the global crisis. That's the euro crisis. And that is a 17% compounded rate of return in the US, which is nearly twice that of the S&P during that period. $100,000 has turned into $683,000 in that period. And it's had an outstanding run since that. But these days, since I stopped doing that, I in fact have been testing it since this period, going forward with my old money in the UK. I do trade in the US, but I only swing trade in the US. I don't trade long-term positions in the US, although maybe I should, to take advantage of the covered calls, although I'm worried about, in fact, just getting too thin. In other words, doing too many things and making mistakes. So if you're worried about how to put that all together, I've got a plan. I've got a very special plan for you. That was me trying to do it myself. I just couldn't keep the fundamentals under control. When I started this, I was in South Africa. I was playing professional rugby. We were playing to 60,000 people every Saturday afternoon. I didn't have the time, and I certainly didn't have the inclination to fight with the annual reports. So they just piled up in the corner of the office. So I traded technically for most of the time. And then I found VectorVest about 10 or 12 years ago that did the fundamentals for me. And that's helped my performance significantly. So to break out, I've got a plan. And if you give me 30 days, we'll use VectorVest to turn your portfolio around. And I've got a little course that'll show you exactly how to put this all together. It's built into VectorVest. Those of you that have got VectorVest, you've got it already. You may not know that, but you've got it already. The first module is how to analyze any stock very quickly. And that's more detail on what I talked about earlier. And in 30 seconds, you should be able to work out good from bad. Module number 2 is all about risk. It's all about position sizing. It's all about maximizing gains, minimizing losses, pushing up your risk to reward ratio, building a positive expectancy system. So 1, separate the good from the bad. 2, get rid of the bad ones. 3, know when it's time and it's safe to buy. And that's the detail of our market timing systems. What to buy. Cherry picking checklists to suit your objectives. And then a module on how to put it all together, how to fit everything into that 10-minute schedule a day. And in the US, they charge a fortune for that. But if you roll up your sleeves, folks, it's normally £5.95. And that includes VectorVest for 1 month. But as a holiday special, if you go to that link, it's going to cost you 99 pence. So that is in fact incorrect. Today, that is 99p. So for your 99 pence, you're going to get my Successful Investing Quick Start course. You're going to get 30 days access to VectorVest itself, which is worth £49. And let me note that after the 30 days, if you don't want to continue with VectorVest, then just give us a shout. We're fully authorized by the FCA. I assure you there'll be no problems about stopping it. If you want to continue, it's £49 a month on a month-by-month basis. And my promise to you is that if you can't make money with VectorVest, you can't make money with my help, then you can stop at any time. Now, I've been with VectorVest now 11 years, and I've never had one single problem with a credit card in 11 years, in both here and in South Africa. During the 30 days, you'll be invited to my webcasts. You'll be invited to our national webcast. You'll be invited to the international webcast. You'll be invited to the US webcasts on a Thursday. Glenn Tompkins does a wonderful webcast on a Thursday. This week he's going to focus on infrastructural stocks because of this $1 trillion that is going to be spent on infrastructural projects in the US. And lots of people have used this over the years, folks. This gentleman's a farmer. He's from north of Somerset, lovely, beautiful part of the world. He's been trading for 30 years and he's never made a cent. And I've been working with him. He's been buying the top and selling the bottom consistently for the last 30 years. And he tells me that he's finally got a plan after all these years. So if you go to vectorvest.co.uk/proven, you'll see that the offer, which is £5.95, there is a special on today for 99 pence. Okay, so just go to that link and you'll find that is 99 pence for this evening. So those of you that are VectorVest customers, let me show you where it is. If I go to here, if you go to training, there it is, under training. There's the 5-part course. If you've got questions about navigation, oh, go away, Boston. If you've got questions about navigation, click on that. It opens in a different window, and there's a series of videos on every single part of VectorVest done by Glenn Tompkins, who I mentioned a moment ago, who's grown up with the program. He knows it back to front. On the homepage, on market timing, stock viewers, industries, watch lists, charts, 3 sessions on Unisearch, the back tester, portfolio manager. That's where you can set it up to in fact give you an email when there's something to do. So and of course any problems that you've got, you can in fact phone our toll-free number, and that toll-free number is open from 12 o'clock every day to 12 o'clock at night. So if you just click on vectorvest.co.uk/proven, that will take you to a sign-up page, and you'll see that that's 99 pence this evening. Okay, so folks, thanks for listening to me. I hope you've enjoyed the presentation. Any questions from anybody? We've all been very quiet. So please take advantage. That 99 pence offer is there for a day or two. Please take advantage of that 30-day trial of VectorVest World. That includes the UK, US, Canada, Europe and Australia. And that's going to cost you 99 pence. And then you can make your mind up after 30 days as to whether VectorVest is for you. It's on a month-by-month basis. After a month, if you pay £49 and you think it's not for you, you can stop it. There's no contracts. Okay. All right. If there's no questions, I'll wish you all a very good evening. Thanks very much indeed.